Okay, so last session we had our current portfolio, our recommended portfolio, um, and we saw our efficient frontier, so we have a recommendation. So now what I want to do is something that is not done in practice, and you'll quickly see why it's not done in practice. But I actually think if we were honest in this industry, this is something we would definitely show. So I brought in your client's current portfolio, 70% in stocks, 30% in just bonds. Your recommended portfolio, as long as your recommended is on that green row on the model output, then you're referencing the right row here. A risk tolerance. You have to pick a risk tolerance for your client. Very, very subjective, but the general rule is if it's someone who's very young, like a 20-something-year-old, you can use a high risk tolerance of like 5%. If it's someone nearing retirement, then maybe you do the generic 1%, or if it's someone in retirement, maybe you go 0.5% even lower. I'm sorry, 0.005% or even lower. I'm going to use 1%, but whatever you select, you have to justify in your paper somehow. But that's the general rule: is younger people have a higher risk tolerance than older people. And then what we're going to do is compare our current portfolio to our recommended, and we're going to use the parametric analysis, which we had in our assumptions, and we're going to calculate a VAR. Now this is VAR, this is not standard deviation. When you're running your efficient frontier, you're comparing to standard deviation. Here we're actually looking at it relative to VAR. So VAR, we're using 2.3 standard deviations from the mean. So the difference, these two will be different. Their VARs will be different because the expected returns are different. You'll notice that is essentially the difference between the VARs, is because you're taking the mean minus the standard deviation. Since these two portfolios had the same standard deviation, and you take the mean minus 2.33 standard deviations, they get the VAR, then the difference is going to be whichever one had the higher starting return will have the lower, the less negative value at risk. So there's your parametric assumptions, just like we told our client. If you look back at the efficient frontier, just like we told our client, we expect the portfolio we recommend to have, we're expecting a higher return at the same level of risk. That's true for standard deviation, but it's going to be a slightly better value at risk because we have a higher expected return. But let's compare that to historical data, and here you'll see immediately why our industry does not like showing this, because in fact, if you look at the actual historical numbers, the current portfolio has had a higher return than the recommended portfolio and has actually had slightly lower risk. So the exact opposite. Now, why would that be? So if you look at the portfolio, it has much less in large cap stocks. It has about 30% in large cap stock versus 70%. Has a whole lot more in small cap stocks. That's probably helped. But probably the biggest difference is it's got 32% in developed market and emerging markets. And while our assumptions say, yeah, those are great places to be, they reduce risks, they give you good returns, in reality, emerging markets and developed markets have done very poorly the last several years since 1988. And so that really is the difference. You can explain that in your paper. This part, you just put the table in and you can try to explain it. So this particular portfolio, the big difference is those international stocks. Now, some of you, if you have a portfolio where the allocation to bonds changes a lot, that's another place that can give you a big difference, because if you go from 10% bonds to 30% bonds, or 30% bonds to 10% bonds, there's a huge difference in what we're assuming bonds would do going forward versus what they've gotten historically, because bonds have very high returns historically because interest rates have fallen so much since 1988. But we don't expect those high returns going forward. So that would be a perfectly legitimate reason. So essentially, the reason this portfolio looks worse when you look at historical data versus looking at our assumptions is that we are assuming developed market, emerging market stocks are going to do a whole lot better going forward than they have historically. Can you imagine trying to explain that to a customer? So a paragraph or two where you bring in this and you explain history versus your recommended, and it's an awkward explanation to make, but I still think we should have to do that. So that's the historical VAR. Now we'll do the style analysis. For the style analysis, you need to pick a mutual fund. You can pick any mutual fund that's a balanced mutual fund. So that means it has to have at least 2 asset classes in it, stocks and bonds. And you can pick any kind of balanced or asset allocation type of fund, except for this one, the Vanguard Index Balance Index. You cannot use. That's its ticker, VBINX. You can't pick that fund. So what do? Is you go to the internet and you look at on Yahoo Finance. If you go to Yahoo Finance, you bring in that fund, bring in historical data. You want to do it on a monthly basis, so you change this to monthly. Go back as far as you can, but know in this model, it's very, very important, this model starts October 1992. So you need a mutual fund that goes back to October 1992. So what I do in here is, since I need October 1992, I'll have my start date be right before that. So I'll do 09/30/1992. And then I'll do, instead of daily, I'll do monthly. Then make sure you hit the apply button. So all this is in Yahoo Finance. You type in your ticker, you go to historical prices, you hit the apply button, and then you can download the data. When you download the data, it will bring up an Excel or CSV file. So you open that. I've already downloaded, I've already typed in the number or copied the numbers into the file I'm using. They'll be slightly different because these things are affected by dividends. So you'll notice that the numbers in my chart are slightly different. And so you got to find the fund. I'll help you find the fund while we're waiting for that to load. It does take a while to load. Let's look at a place you can go. So if you go to the Vanguard.com or Fidelity.com, there's a lot of places you can go where they'll list all of their mutual funds, and they'll list them. So this is Vanguard and all of their mutual funds. What we're looking for, sorry, my machine really is acting up. What we're looking for, we don't want investment grade, we don't want tax exempt. You just kind of go down here. You see the word balanced funds. You want a balanced fund. You probably do not want to use one of the target funds. They don't work well for a couple reasons. First of all, they change their allocation over time, so they're not good for style analysis that I'm going to show you how to do. Also, Vanguard's really good because they put the inception date. Remember, we need to go back to 1992. So if you look at the dates, their target funds don't go back that far. So now we're getting a little bit better down here. Here's one. The Star Fund works really well. That's one you might use. And so with the Star Fund, since it goes back to 85, you have plenty of history. Here's one that goes back to 1970. This is actually a really good one to use, the Wesley Fund. And then the Wellington goes back the furthest. Wellington and Vanguard used to be affiliated with each other. I can't remember exactly what the arrangement was. But there's a few choices there. You just can't use the portfolio I have in there, and it actually doesn't even show up because they've stopped selling those shares to the general public. So when you do that, you'll bring in the data. When you bring in the data, you can see that I put 9/30/1992 as my start date, so it actually starts with September, and that's what you want. So if you put October, if you put October into the start date, it won't bring in October, it will start with November. So since you're starting with October of 1992, have your start date be 9/30/1992. And what we're going to use is adjusted close. The adjusted close, you can notice it's much lower than the close, and what they do there is they adjust the mutual fund's price for dividends so that you get a true total return. So when you look at my file, you go back to 1992 and you copy and paste those into this green section. You paste them as values. So you right click and paste as values. And then if you go down to the bottom, it ends at 12/31/2019. If you copy and paste everything in, it will probably give you January, February, and March. But this spreadsheet will just ignore if you have those other months. It should just doesn't do anything. So if you have other things keyed down here, it's not a problem. So let me show you what this actually does. So let's say we'll start with 25, 25, 10. I don't know what will be in here, but well, probably what's going to be in here is whatever I had for Vanguard. So let me just put in some numbers, just almost randomly. So with this allocation I have in here, I get an R squared of 85%, which means this allocation up here explains 85% of the volatility of this VBINX. And you might even Google style analysis. It's a really famous approach to assessing mutual funds. So we're trying to figure out where is this fund taking its risk. 85 is okay. It gives us some explanation, but we could probably do better. And so all you have to do again is just data, solver. And what solver is going to do is get that R squared as high as possible by changing those allocations, making sure they add up to 100%. So you don't have to change anything. Just type solve, and it will start looking. You'll notice it's getting up into the 90s already. We'll see how high it can get. It found the solution. So now we can explain 94% of what this fund does. And there's the allocations. You might even go on the Vanguard if you did a fund like this and see what they say the allocation is. You can see this fund is about 40% bonds. If you include the high yield, it's about 45% bonds and 55% stocks. And the stocks are all U.S. stocks. There's nothing in developing, emerging. So this is a very U.S. focused fund. You can explain 94% of the fund's performance. You don't have to be in the 90s. It'd be nice to be in the 90s. It'd be nice to be in the 80s. I wouldn't drop too far below 80%. If you get below 80%, you probably have an issue. If you have problems with this is something you can email me or call me, and I'll help you through it. Vanguard's not the only place you can go. There are other places. Vanguard's the one place that shows the start date for the fund, so it just makes it a little easier. I know USAA has some funds that used to work, but USAA has restructured those funds, so they may not have the history back that far. I'm sure Fidelity has, and T. Rowe Price and some others have funds that go back many, many years that you can use. And so what we've done is we've taken the return of this fund, taking this allocation versus benchmarks or indices, and we're trying to compare the two. So I created a chart that I really like. This chart. It's a really cool chart. Let me resize it so you can see it. And it just compares the Vanguard fund to that best fit. You can see how it does move very much together. You know, stretch it out. I don't know why I did that. You can see it moves very well together. This is a Vanguard index fund, so it's going to follow the index extremely close. So it's not bad they're not beating the index. That's not their intention. Their goal is to match the index as closely as possible, and probably they're beating the index mainly because they do some securities lending or other things that help offset their fees. But that's style analysis. So what you're going to do here, this is the most important part. So make sure, I know these videos can get a little tedious. Make sure you're paying attention here. This is the allocation that best explains this fund. So you're assuming, okay, my client came in with this Vanguard fund and they're asking me, hey, can I use this fund to do the recommendation that you're giving me? And what you do is you look at this fund, you can see it's all U.S. stocks, and yet your recommended fund is heavily skewed toward developed market, emerging market stocks. You can see it's 32% in international stocks and only has 30% in U.S. stocks or U.S. large cap stocks. You look here, it has nothing international and has 54% in U.S. large cap stocks. So your answer is going to be no, this fund does not make sense. You can't use this fund. It's too U.S. focused. The recommendation I have is to get more developed emerging market stocks. and you stop there. You do not, some students get really confused. You do not have to go out and find a mutual fund that matches your asset allocation. You will not find one. So you just stop there and say, no, I ran a style analysis, and the mutual fund you have does not match the recommendation I'm making, so this fund would not be a good fit with your portfolio. You just stop there. It usually only takes 1 or 2 paragraphs to get through the style analysis. Most of your work is actually getting the fund, bringing in the prices. It's not that difficult to do. Again, if you're having struggles, don't waste hours. Call me, let me know you're struggling, and I'll walk you through it very, very quickly. I can give you some ideas of funds, or I'll help you look for funds online. I mean, I'm here to help you get through this because the stress of this semester is already pretty great. So don't stress yourself out. As soon as you feel the stress, you feel yourself wasting 30, 45 minutes, you don't know what you're doing, stop and come to me. Now, the last thing we're going to do here is manager attribution. So for manager attribution, I'll build this from scratch. It's probably the most tedious one in there. There is another video out there that does this as well, so you have a couple of examples. Next class, our next class actually in the next week, I'll show you how to do this from scratch. It is an amazingly wonderful skill to have. There's a high probability you will need to do this in one of your first jobs, or if you're not going to do this, you might have a job where you're using a service like Morningstar or Lipper that's doing this for you. But it'd be really great if you've done this yourself manually so you understand what those software packages are doing. What you have to do here is very different what you did in style analysis. In style analysis, you're looking for a fund that invests in multiple asset classes. You can now see why that's important, because the style analysis is actually trying to figure out what asset classes, what allocation to asset classes best explains the risk this fund is taking. Manager attribution, you're not actually commenting on whether the fund did well or not. You could comment on it if you want to. You can see Vanguard is right in line with its index, so that's good. But your main issue here is this fund a good fit for your recommended asset allocation? And since it's not going to be, how well it performs is almost a side issue because you're not recommending this fund. Manager attribution is your customer comes in with a mutual fund that does one asset class. So this is the Fidelity Contra fund. When you look at the Fidelity Contra fund, it is a growth fund, so it's U.S. large cap growth. So what we're going to ask is, how has this fund performed? Your client says, hey, you want some U.S. large cap growth, can I use my Fidelity Contra fund? Is that a good fund? And you'll do the analysis, and you'll try to let your client know whether you think they're better off buying the Fidelity Contra fund or just put all your money into an index fund. So that's the next thing we'll do. Very, very powerful skill to have. We'll do that in the next class. I wouldn't worry about any of this until you get paper 1 behind you. And then when you do this project, I would do the first 3 parts of this project: the efficient frontier, historical VAR, and style analysis. Get those done. And then you'll need a little more time to do the manager attribution. It is more time consuming. You'll see that's why I'm going to need probably half of the next class to walk you through that. All right, that's it. Thanks a lot.